Today's big idea: the United States used to act like the world's quiet insurer, backstopping liquidity, stability, and access to deep capital markets. That insurance policy made the dollar and Treasuries the safest place for the world's extra savings. But Washington's recent choices are shrinking that safety net, and the map of global money, trade, and influence is redrawing itself in real time. As a disclaimer, this is basically a summary of the author's opinion, that author being Adam S. Posen, who is president of the Peterson Institute for International Economics. And this is from his article, The New Economic Geography, in this past September-October 2025 edition of Foreign Affairs. So, also for a good kind of I'll say a different view on things, I'd recommend looking into Jeff Snyder and Eurodollar University or Britt Johnson, who are both two other great sources of info. It's always great to get different points of view, and those are two that I've looked into a bit more, to say the least. But anyways, so what's Posen's lesson? It's simple but unsettling. When the U.S. undermines dollar liquidity, if I could talk this morning, wow. When the U.S. undermines dollar liquidity and predictability, everyone else must self-insure. That means fewer truly, quote, safe assets, higher long-term rates, and more abrupt swings into alternatives like gold, other commodities, or crypto, followed by crashes, according to him. Meanwhile, countries that long relied on U.S. market access and rules are hedging toward one another and toward China, accelerating a new economic geography in which regional ties and non-dollar arrangements matter more. First, dollar safety and liquidity are being eroded by explicit threats and erratic policy. Posen catalogs proposals to, quote, trap investors in Treasuries, punish non-dollar use, tax foreign holders more, and pressure the Fed. Signals that previously low to no risk U.S. assets can't be treated as entirely safe, and that change, he argues, will have far-reaching effects on global capital flows. Secondly, you can see the break in the data. So historically, the dollar often rose with risk and with tariffs. This year, after April 2nd's tariff announcements, the usual relationship flipped, suggesting something beyond routine economics in pushing the dollar down. Third, repeated shocks, April's Liberation Day tariff, again April 2nd, and then May's One Big Beautiful Bill, June's new tariff threats and the bombing of Iran were followed by a falling dollar and rising long-term U.S. rates consistent with capital flows away from the U.S. assets when policy looks unstable. Fourth, Posen says the insurer's clients are changing behavior. So Japan, a model partner for decades, now faces steep costs. A mid-July deal slapped 15% tariffs on major industries, including Japan's auto parts, and steel industries, and extracted a commitment to channel an additional 14% of Japan's GDP into the U.S. with profits partially seeded and funds at the president's discretion. An obvious downgrade from private sector investments. Fifth, others are tilting toward each other and toward China. So ASEAN and the EU already have deeper commercial ties with China. That gap is widening as the U.S. limits trade and investment with Beijing. Posen points to rising Chinese content in European and Southeast Asia supply chains and new projects and currency arrangements. For example, Indonesia's spring 2025 twin industrial park with Fujian, and steps to boost local currency trade with China. Sixth, the macro consequence, so fewer safe places for the world's savings. When U.S. assets become less liquid, long-term treasury rates drift higher just as issuance surges because so many loans are priced off treasury rates. That raises borrowing costs across the system. Meanwhile, shifts into less liquid stores of value raise the odds of periodic crashes. Finally, why this bites so hard? The world has more savings than truly safe homes for them. So surplus economies like China, Germany, Saudi Arabia, and others can't absorb all their savings domestically without bubbles and distortions. For decades, the U.S. market soaked up that overflow thanks to depth and liquidity. Undercutting that setup forces everyone into riskier, pricier self-insurance. The takeaway from Posen is if the U.S. stops behaving like the predictable worldwide insurer, the world won't wait. It will rewire. Capital will diversify away from Treasuries. Allies will hedge, and regional, industrial, and financial ecosystems will deepen, often around China, because the alternative is to stay exposed to U.S. policy whiplash. The result isn't a stronger America, but a world with fewer safe assets, higher costs, and more frequent financial accidents. For policymakers and firms, the assignment is clear. Price in less dollar liquidity, seek redundancy in financing and supply chains, and expect alliances to be judged by economic reliability as much as security guarantees. So I'll say again, this was definitely his opinion. I think there's quite a few holes in it, if I'll be completely honest. But again, I will cite Jeff Snyder and Brent Johnson for a lot of that kind of background content, as it's already out there, and they have decades of experience, for one. And for two, there's no point in getting into all of this as I try to keep these relatively short. So with that being said, please let me know what holes you guys see in the argument. I mean, that's kind of the point. Even like when I talk and give my own thoughts and kind of try to analyze stuff in and of itself, always look for holes in everyone's points of view as it deems like at least a greater understanding on all fronts, to be honest. Like, it's just good to do that and always look with somewhat of a inquisitive eye on things. But anyways, I'll leave this here, and I hope to see you guys on the next one.